So welcome back. Thanks very much for bringing a friend, for those that did. This is the last session of today, the Finance Day, Impact Investing, the Next Frontier for Climate, and it's hosted by CPI. So without further ado, I want to introduce you to Barbara Buchner, the Executive Director.
Great. Thank you so much, and thank you very much for being here with us in this last session of the day. I'm delighted to be your moderator today. My name is Barbara Buchner. I'm Executive Director of CPI. CPI works to provide analysis and tools to basically help policymakers and decision makers to really support economic growth while addressing climate risks and increasingly scarce resources. I think you've heard already before that we do kind of an overall overview of how much money is flowing, who are the actors involved, where does it end up. I'm not going to start with this one here, but I'd be very happy to give you a little bit more details later. Just maybe the key finding, the key takeaway from our most recent assessment is that in 2015, we did observe record highs in climate finance. We saw an increase to $437 billion of global flows, which is public and private. That record high was mainly driven by a record surge of private investment into renewable energy in a few geographies like China, the US, and Japan. But we did see a 12% drop in 2016, again, also because of some reductions of technology costs, which is very good news because it means that sustainable technologies are becoming competitive with the traditional fossil fuel-based ones. But at the same time, we did see a little less capacity additions in a few countries. But again, I think the overall takeaway here is that if you look at the 2 years average, which makes sense given the annual fluctuations, you can see that the 2015-2016 annual number was 12% above the number of the 2013-2014 flows, and I'd be happy to give you more insight. But this panel here is going to look at one specific segment of this overall spaghetti graph of our overall landscape of climate finance. We are going to look into impact investing and planet finance, which have become more and more tools to really achieve both financial returns, but also help drive sustainable development. So we have a fantastic panel today here with me. Very excited that all of you could make it, and thank you for that. And they will be sharing their invaluable insights and expertise on this topic. And I just want to make sure that we all have a shared common understanding on planet finance and on impact investing. I know that there's a lot of jargon going on, so just before we jump into the depth of some of these tools and of some of the related trends, I just want to make sure that we're talking about the same thing here. So what we see as impact investing is really investments that seek to achieve measurable, beneficial, social or environmental goals, while also at the same time being sure that there are financial returns. And if you look at planet finance, it basically is a subset of impact investments, which is using a combination of concessional and commercial capital to actually achieve these impacts alongside financial returns. So we have seen progress in general in more and more planet finance tools that try to pilot some of the ways that we can use in order to close the investment gap and really kind of bring in, use the concessional money that we have more effectively to drive private capital. We have also seen innovation, and I've heard in the last panel there was a lot of discussion around the importance of innovation. So we have seen quite a lot of innovation in driving and developing these tools. And I just want to share one experience that we have, and we have actually everyone here on this panel has been part of this experience, which is a public-private initiative that we run at CPI. And that is called the Global Innovation Lab for Climate Finance, which really brings together public and private investors in order to identify, stress test, and ultimately pilot new financial solutions that can unlock private investment at scale with the overall hope to really kind of address climate change. And in a little over 3 years, we've helped through the lab instruments, to mobilize almost $1 billion for concrete projects around different sectors and around different technologies in different countries of the world. And that obviously isn't good news, but what we also see is that there's lots of barriers and gaps out there. It's particularly difficult to drive and replicate some of these pilots in specific sectors, in specific regions of the world. So I think what I'd like to go a little bit deeper in today is really understanding some of the experiences of our panelists on how to come up with these tools, what are the challenges in really implementing these tools and attracting some of the impact investors, and what can we really think about like potential solutions and next steps that are needed in order to really make sure that planet finance and impact investing can help to really scale up climate investments. So with that, I think I'm going to immediately introduce the panel here and then hand over to my panelists. So you do have on my left here Andrew Johnstone, who is the CEO of Climate Funds Managers, and he's the founder of Phoenix InfraWorks. Andrew is the proponent of one of our first lab instruments in the first cycle that managed to achieve a very nice close earlier this year, and I'm sure you're going to talk about that a little bit more. But it will be great to hear more your thoughts on your experience with this instrument, which is Climate Investor One. Close to Andrew, we have Upendra Bhatt, who is co-founder and managing director of cKinetics and director of the cKers Finance Board. And cKers Finance, again, is also a proponent in one of our labs, the India lab, and they have been developing the sustainable energy bonds, which is really, again, with the goal of really attracting impact investors. So it'd be great to hear a little bit your experiences in this context. Close to Upendra, we have Lorenzo Bernasconi, who is a senior associate director of the Rockefeller Foundation, which not only is a really important lab member and founder, but also has been investing in some of the instruments coming out of the lab, including the GRIPS instrument, and looking forward to hearing your experiences also from the other side a little bit. Close to Lorenzo, we have Abyd Karmali, certainly well known to everyone in the climate finance community. Abyd is managing director of climate finance at Bank of America, Merrill Lynch, and has been a lab advisor from day one and very instrumental to the overall progress and success of the lab and its instruments. So it would be great to hear your perspective from a commercial bank going forward. And then last but certainly not least, we have Harald Hirschover, who is senior advisor at TCX, the currency exchange fund. And Harald, again, has been also a proponent in the first cycle of the lab and coming up with a very innovative thinking around foreign exchange risk hedging, which certainly is one of the issues that are very high on the priority of investors. So with that, let me get started immediately, and let me just hand over to Andrew for your initial reflections on what were your challenges in developing Climate Investor One, and what have you seen has really worked in order to attract some of these impact investors.
All right, thank you, Barbara. Ladies and gentlemen, good afternoon. It's a pleasure to be here. The story of Climate Investor One goes back about 3 years. I won't bore you with the whole 900 days of it, but safe to say that what we've ended up with is a financing vehicle. Climate Investor One is what the name says. It invests in climate-related investments, and the one signifies the beginning of many more. The aspiration was to come up with a financing vehicle which addressed deficiencies which we experienced in the past that could be replicated both within the sector in which we are targeting as well as the broader sector of climate finance, be that energy, water, landscapes, and the likes. Originally, we set out to address what we perceive to be blockages between the deployment of capital and the actual uses of it. And the appreciation came largely from an emerging markets perspective. The idea, its origins lie within the bowels of the Dutch Development Bank, called FMO, who have extensive experience over the last 60-odd years investing in most emerging markets globally. And personally, I've done a lot of work in Africa right across the infrastructure sector. And what we really found was two things. One was, notwithstanding everybody's best efforts, there were insufficient projects actually being done. And the reason for it is everybody perceives the risk to be too high. Simple as that. So we set out to try and address those two things separately. On the first, we sought to simplify the way that capital gets mobilized into the projects. And on the other hand, to try and address the risks, we separated a continuum of what people perceive to be risk from early stage all the way through to an operating asset into discrete phases of development, construction, and operations. And through that architecture, we were relatively successful in demystifying what scares a lot of investors in the market. The consequences, we successfully closed the fund on its first cycle at $412 million. But relevantly for this forum is that involved 2 governments, 5 pension funds, 1 credit export agency, and 2 insurance companies. And therein lies the significance, really, I think, of what we've done, is that through the use of blended finance and pursuing this emerging method of deploying capital, which is, in truth, largely undefined at the moment, there is a rallying call for parties to work much more collaboratively in pursuit of a common goal, which is to deploy money at scale than there ever has in the past. And I think that the first step of Climate Investor One is testament to that willingness broadly within the financial sector to actually work in a different way to get money deployed quicker and at scale.
Great. Thank you so much, Andrew. I'm sure that has created a lot of interest, and I do see, a real opportunity here also to take this approach and replicate it elsewhere, because I do think that you are actually addressing some of the key risks and some of the problems that investors see in the market. But let me maybe come directly to Abyd and listen to you a little bit from the point of view of a commercial bank. What have you seen as like some of the most effective or least effective ways of trying to use blended finance to both kind of generating impact, but also making sure that there is financial returns, or do you see any kind of trade-off between the two?
Great. No, thanks very much, Barbara. So you mentioned the our role in the innovation lab, and just to comment on that first, I think it has been a really interesting experiment. We've been very pleased to be a part of it, and we see it actually as part of a portfolio of innovation that we're trying to be involved with, because we take a view that clearly there's this massive financing gap. We need to close the gap. We therefore need new financial instruments, and so our other starting point is that it's possible to green every single financial product. It's just a matter of whether the market is ready to take those products up. So we are looking across all the asset classes. We are trying to prepare products for the big pools of money, the $90 trillion in assets under management with the institutional investor community, and it's good to hear, Andrew, that you managed to tap into some of those big pools as well. But then, with our business as a global financial institution, we also have a wealth management practice, which has around 2.6 trillion in assets under management, and we do track the number of that 2.6 trillion that is interested in what we call ESG-related investment, environment, social, and governance. That number is going up year on year. It's very exciting to see. And if I can just add a little detour here, perhaps one of the drivers there, and this gets to one of your points, it's now not the ESG thematic long-term specialist research from our research department, Bank of America, Merrill Lynch Research. It's not them that are coming out with these reports talking about ESG. It's actually the mainstream equity analysts, and that for me is a game changer. It's the mainstream capital talking about things like, I remember the last report, in the U.S. equities market, the top third performing equities on ESG outperform the bottom third by 18% over, I think it's a 5-year period. So there's a phenomenal, it's a phenomenal, if you like, we're at a climate conference, but canary in a coal mine, because it's giving an indicator for investors that there is, that it's a proxy for good management and it's a proxy for financial returns. So this, I think, leads me to another point, which is you mentioned where we see blended finance fit in with impact investment, and is there a trade-off? And what's exciting now, I think, is that there's a genuine debate in the markets about where one needs to be on this 2x2 matrix, right? You've got on the one hand financial returns, and on the other hand social returns. And clearly, investors are all over this map, but there are some products now that basically take the hypothesis that you don't have to trade off financial returns and social returns. As one example, we are an investor in a private equity fund that is managed by TPG, so it's one of the world's biggest private equity firms. It's $2 billion, and it's focused only on the SDGs. So I mean, this again is another indicator that the big money is coming. We're in there for $150 million. They've done 5 deals to date, and the deals are in Indian dairy farms and Internet of Things to do with energy-efficient ovens and ESG-related education platforms. So it's all over the SDGs. Very exciting. I know you want me to talk about blended finance as well. So on blended finance, there are basically a whole suite of roles that will help crowd in more private money in those areas where we need to see some de-risking, some lowering of the cost of capital. And just let me maybe highlight 3 quick ones. So earlier this year, I think, maybe last year, losing track a little bit, but we helped arrange the world's first forestry bond. Now, this was a good example because it needed a AAA-rated institution to provide the credit. It was issued by the IFC. Investors are not yet comfortable, I don't think, with the whole forestry area, ecosystem services. That there needs to be some credit enhancement type role. So that's a good example of one. The role played by the public sector was really providing the credit enhancement. The second is these green banks that are popping up, right? So you've got New York State Green Bank and Green Investment Bank and Clean Energy Finance Corporation, all these different vehicles that, to be perfectly honest, are there because we haven't got a material price on carbon, right? But anyway, second best solution, but it's helping with some of the financial engineering. There, the role is more of a cornerstone type investor. So typically, interestingly, they're not going in with concessional debt. They're merely there to shine a light to say, look, actually, don't worry about the policy risk here. We're a public sector institution. We understand it better than you ever will in the private sector. Trust us. Famous last words. But it's been successful. We have seen some interesting deals done. We've been involved with credit lines on energy efficiency in the U.S. states. I know that's probably not the main subject here, but also some of the green bonds that have been issued in emerging markets. For example, Energía Eólica in Peru, one of the first green project bonds. There was a Latin American development bank that came in as one of the buyers of the bond. So another good example, perhaps. The last one I'll give you is the classic blended capital stack, which is a fund which is being launched called Water Equity. Now, again, this is it's trying to marry up the scale of the private sector with the mission of the public sector. Lorenzo and his kinds of organizations, plus the mission orientation, if you like, of public capital. And that one is focused on clean water, sanitation in India, in other parts of Southeast Asia. We're in as the top tranche, the super tranche, because we need to see some de-risking. It's an area that's new for us, but we're very happy to be in there with partners, and hopefully this is going to be a big success.
Great. Thanks so much, Abyd, and thanks for sharing these specific examples. But also, I think what we see the same thing that you just mentioned before in our landscape tracking the climate finance flows, that the good news is really that mainstream investors really become part of increase their really kind of their role in the overall, climate finance landscape. So really we have seen over the last few years really many more deals from mainstream investors and not anymore the ones at the margins that are the ones who want to do good. And I think that's a very promising signal. Still not enough, but I think it's going in the right direction. But as you mentioned already, Lorenzo, let me ask Lorenzo, what do you think? I mean, your experience in bringing, concessional capital into commercial deals, but also, what are you looking for when you look for impact investment opportunities from your side? And maybe if you have an example to share that you would like to.
Great. Well, let me also just echo that. Thank you for the opportunity. It's great to be here. Maybe just quick background on the Rockefeller Foundation and this space. We've been doing kind of impact investing, as we've called it, since about 2008. And we're one of the first US foundations really to try to showcase that there is such a thing as impact investing, and invested in a lot of the early funds, whether that's the African Agricultural Capital Fund, IGNIA, Acumen, and so on, some of those names that you may have heard of. And then kind of more recently, really have doubled down again on finding ways in which we can use actually money that comes out of our kind of giving portion. So in any US foundation, you've got the endowment, and then you've got a certain kind of amount that you need to give away. In the US, it's a 5%. And some of that money can be deployed as investments. And so really thinking about how can we most effectively use that money to bring in large-scale private sector investment capital. And so clearly, blending is part of that equation. And you know, throughout the years, I think there's a number of things in terms of how we look at this. Firstly, we will start by looking at it in exactly the same commercial ways in which any traditional investor looks at it. But then there's obviously a number of additional components that we will look at. Firstly, of course, impact, and that's like the sine qua non. We have to go in both legally and also in terms of the mission of the foundation with an impact-first component. So we will only go in there really for charitable reasons, not so much with a kind of interest of necessarily just scaling or leveraging private sector investment for the sake of that. Secondly, we will look at additionality. So the question there is this something that a private investor would have done otherwise, or you know, it's a counterfactual which we ask ourselves, you know, were it not for our investment, would the private sector not have come in? It's basically the question we try to answer. And of course, that's more of art than it is actual kind of science, but that's the key question we also need to ask ourselves. Third point, alignment. So it's great to be able to say, oh, we've brought in, you know, Bank of America or whoever else it may be, a big brand name into a deal, but we need to see at what cost we're doing that and to make sure that in the worst case scenario, we still have a certain alignment of interests. And I've had several experiences where certainly at some point the commercial investor looks at things very differently from the impact investors, and that can become very complicated if things go a bit sour. Fourth point, efficiency. So sometimes we shouldn't go into this assuming always that the private sector necessarily needs credit enhancement or needs an investment to be de-risked. In some cases, the private sector may be happy to take on the risk so long as the returns are there. And there's maybe other ways, creative ways in which we as a foundation can be involved. And then I think finally, we look at the end game. And I think this is a very important point in the blended finance discussion, which is thinking about investments where we forever, or investments forever rely on concessional finance is not going to get us there. So we will only go in there where we think there's some kind of a pioneer risk. So for one reason or another, this market is not yet ready for private sector investment, and we can point to very good reasons as to why that's the case, in which case we're very happy to go in there and prove out that case. So there's that pioneer risk, and then there's the other scenario where we may come in a blended finance structure where we really are thinking, look, this is a very important issue area and we need to massively accelerate private sector investment, and the only way we'll do that is through some blended finance structure. But in all of these cases, the long term is this has to be something that will one day stand on its own and be able to attract private sector investment on its own.
Great, thanks so much, Lorenzo. And I think that the end game, as you just said, is certainly something which we also see in the lab is attracting lots of investors, really this being in the longer term financially sustainable. So it's really something where you use your money most effectively to then make sure that over time this becomes a real commercial vehicle and a really commercial tool. But you were talking about pioneer risks. So let me actually ask Harald, who clearly has been facing some pioneer risks in the work that you've been doing at DCX, a little bit your experiences, with how you've been trying to you come up with blended finance vehicles, but also what you see kind of as the next generation there.
Barbara, thank you. Perhaps with the risk of being too basic, but let me start out why we are here in Bonn. One of the things is we want to scale up investments to get to the trillions which we need to make a difference in the climate. Think for a second you are a pension fund manager. So what are you looking for? You're looking for low risks. You're looking for big scale deployment, ticket size of 100 million, 200 million. And unfortunately, particularly in the developing world, very many renewable energy projects don't fit that bill. They're either too small or they are too risky. So So that's a problem. We need to somehow resolve this to bridge that. And blended finance, to come back to that, can help with that. Blended finance can help in two things. It can help to foster innovation, to take what Lorenzo said, to take that step which nobody dares to take by being willing to accept higher risk with lower returns. Or at the end, it can also help to scale up existing instruments, or it can help to create new markets, if you want, where you need to deploy massive scales of capital, which is very difficult to find in the commercial market at that risk return. So TCX was, I remember that how I met actually Barbara was that it was quite parallel, because TCX was started 10 years ago as a tool to facilitate local currency lending by development banks. And we have been thinking how we can, in what types of industries we can use that tool, which is a generic financial tool and can be used for many purposes, from microfinance hedging to a small medium enterprise. And we also came across renewable energy. In parallel at that time, the World Resource Institute wrote a paper in Washington about the need to offer FX hedging, long-term FX hedging tools in India in particular, to mobilize investments into that sector. So we met in Holland, and it was, though we are both Austrians, and it was a match, and so here we are. After 3 years, we were one of the first companies which, thanks to the lab, received an investment by the German Ministry of Environment, 30 million in additional capital. We have now about 800 million in capital. And we are now offering FX hedging tool 15 years or even longer in 90 currencies. So if anybody says, well, we cannot hedge in that currency, please talk to us. Because we can. So we can do it now to 200 million per ticket size. It's not big enough yet, but it will help. But allow me to go to the next stage now, because now we need to scale up. And how can we build that bridge between the developer and who wants to build a 10 megawatt, 20 megawatt, and you go even smaller, a 2 megawatt project, right? And the pension fund manager who wants to invest 100, 200 million in one go at low risk. So we have had the privilege to be invited by the Indian government and the French government after the Paris conference to be part of a task force to think about a common de-risking mechanism just for solar PV. So we are setting here one single technology because we believe costs will decline further, and it has very, very good features in terms of low implementation risk, easy planning. And so how do we, in this sector, how can we deliver 15 billion in investment flows in the coming 3 years? So that's our target, and we have a feasibility study is available under the Terawatt Initiative website if you're interested. But in rough, how does blended finance play a role in this? So we see that there are many tools out there, from off-taker risk insurance, inconvertibility risk insurance, like TCX offers, FX risk insurance, where commercial banks like you would not go. But these individual tools lack easy access. It's very difficult for the developer to access it and to know upfront when he bids for that tender, in that government tender, how much the prices would be. So we are proposing now to create a common platform which is acting as a broker, an intermediary between the developer and these various de-risking instruments. So the advantage will be when a country like Kenya wants to issue 300 million tender or 300 megawatt tender, or a group like the Caribbean island states want to allocate 100 megawatt, they can make a joint tender which is informed by the costs of the de-risking instruments. And because they know these de-risking instruments, they can bid more courageously. The prices will go down even faster. And you can also, at that point, when you have the creditworthy projects attract aggregating vehicles to pull all these individual smaller projects together and offer it to institutional investors. So that requires a capital structure which is sort of impact oriented, because it has not been done before, like TCX. It requires some people who take higher risks, are willing to accept below commercial returns for that. And we are now in discussion, and I hope at the climate conference in Paris, which was called by President Macron, we will have some further progress towards that goal, and certainly the discussions we had here in Bonn so far are very helpful. But I think blended finance is very important to help scaling up, and this is what we need. We also need innovation, but we need to scale up right now to achieve the climate targets.
Great, thanks so much, Harald. And I think that's obviously a question I would love to ask the panel in the final round after a few questions. But first, and not last, and first, certainly not the least important of this panel, but I'd be very interested, Upendra, to hear a little bit from you, your experiences, and how you think the sustainable energy bonds that you are developing through the India Lab is helping address some of the challenges that we already heard today, and some of the problems that we see in the market that pose barriers to investors, and whether you think that the sustainable energy bonds will be able to attract impact investors, or you are more along the lines of Harald and saying, okay, we need still some additional other bridge or platform instruments that can help actually really kind of get to the next level. So Upendra, over to you.
Thank you, Barbara, and for putting this panel together. When you're the last panel of the day and you have stellar co-panelists, there's very little that can be added to what's already been said. So what we are really putting together for some of you who don't know about cKers Finance, it's a new market-making co-development platform, trying to build a view around project financing at subscale. So when we talk of subscale, that's what Harald was referencing. Looking to do deals for 2 to 10 megawatts, as also in energy efficiency space. And so when you start looking at these projects, and particularly if they are being put together by developers who are doing these as standalone businesses, there's not enough credit track record, there's not enough proven benchmarks, and therefore access to capital is a perpetual challenge. And so the natural port of first call is impact investments. But frankly, over our years in this space, and having worked very closely with Rockefeller in some of the earlier decentralized renewable energy models, it's a mixed experience, frankly. What we notice is there's a lot of talk and desire to engage, but the reality is not proportionate to the hype and the conversation. There are very few real impact investors. If I just take the case of decentralized renewables in the Indian case, and probably Lorenzo may agree, I would be surprised if he disagrees, that there is hardly about $20–25 million of impact-seeking true capital moving annually in that space on the decentralized renewables. And this is when the industry is supposedly close to a gigawatt. The largest investor is the federal government. So that gives you the scale and the enormity of the challenge, right? So that's one. So there is consequently a missing middle. You have the traditional impact investors, the foundation, some of the newer age corporations trying to enter this space. And what they are looking to do really is participate in some beachhead deals and beachhead transactions. But frankly, that doesn't by itself create scale. Second, you have the large DFIs with whom we work very closely with Asian Development Bank and a few others. They are willing to come in, but they would like deal sizes north of $50 million and above. So when you are in that middle range, you have a challenge around forex hedging. You have a challenge around deal sizes necessarily, and these are all several small projects, so you need to aggregate them in a certain way. So that's where with all our work through the years, we set up cKers Finance, which is fundamentally an aggregating mechanism. And the sustainable energy bond is really an instrument to help materialize this aggregation. So what we are doing really, and that's where lab has come in extremely handy, is one, bring in innovation when it comes to capital sourcing. Because how do you create issuances for these smaller bond sizes of $10 to $15 million and make it real and make it effective in transaction costs. To what we are doing in capital deployment, even in sourcing, our first tranches are all being raised in rupee denominator. So we're only trying to work with folks who would be willing to come in, both mainstream and this. I was particularly enthused by what Abyd said, because that kind of correlates with our experience. Our first set of, and because we are structured as a non-banking financial institution, our first set of equity investors are all what you said, primarily high net worth individuals who are looking for ESG impact. And they're not necessarily looking at, from a returns perspective, a commercially high return, but it is an infra level return. Because that's what these projects really are. And that's also a mismatch with the conventional impact investors. Because a lot of momentum and success in conventional impact investment came from microfinance sector. The returns were much higher in the 2008-10 timeframe. It set the bar a little differently. Whereas when you're looking at sustainability projects, whether it is in the efficiency side, whether you're looking at it, these are long tenure projects. And you need to kind of frame the color and the context of the capital accordingly. So we are following a blended capital structure. We have an equity tranche, which is primarily, like I said, driven by mission-oriented, high net worth investors. cKinetics itself has been a key contributor to that initial pool. We have the next tier of capital coming in from partners such as Rockefeller and others, which is really a loss absorption, but returnable capital pool. They take precedence on the waterfall. And then we have in parallel started gaining momentum with what are mainstream capital guys. And with mainstream capital, we are again on the capital deployment, undertaking the deployments in two forms. One, directly coming into us, and for larger deal sizes, because we are working at 20 megawatt plus deal sizes in certain cases, wherein we as an aggregating mechanism take the loss tranche on that deal, and therefore making it very affordable. I think the work cut out for us from a lab point of view is, how do you use these bonds to create precedence of transaction making? I think there is a room for credit enhancement, which can then target and create more scale and momentum. And I think the last part about this is, how do you create this as a standardized mechanism? Because we have been approached by multiple platforms, and it will be keen, we would be keen to learn from folks who have already done that, but make sure it is standardized, so that, because that's part of making the issuance simpler and accessible. And last point before I kind of hand it over, Barbara, I think pace of deployment and pace of engagement from the impact investment community has to go up. I think one of the biggest differences that I notice between conventional impact investors and mainstream investors is a deal which an impact investor engages in is not closed out in months. It can even go up in years, kind of taking a lot of attention away. So I think that transformation needs to come in, because if you're truly impact seeking, you need to also kind of take that leap of faith in these projects.
Thanks so much, and Upendra, extremely helpful and interesting. Before handing back to the panel here, I'd love to see whether there's any questions from the floor. We have one. Do we have one, two?
People are
still awake. I have a great panel. I knew that. Fantastic. So we'll have two questions, and then I'll get back to the panel.
Yes, good afternoon. I'm extremely disappointed by all that has been said, because I think back to the first speech this morning, Bertrand Piccard, who said that everybody from the aviation industry had told him it was impossible, solar impulse, and it was done by people from outside. And I have the impression that in order to really have impact investing, if we think that the biggest risk is climate change and biodiversity, I think we have to think about this from outside the finance industry. Because all the risks that we have been talking about are nothing compared to climate change and biodiversity. I will take just one example. How does one think about risk when one is determining the defense budget what is the defense budget per year of the United States? Thank you.
Thanks so much. I take this as a comment. I think we have a second question and then the third here in the front.
Thank you. Miles McCarthy, Carbon Trust. A lot of the work we're doing with corporates today, and very encouraging work, is corporates recognizing that they need to transition to a 2-degree trajectory for their business in the industries that they work in today and in the future. And also to demonstrate and to report to their investors, and also to demonstrate that they are on that, they are delivering, or they will be delivering, their share of what is required to achieve where we need to get to. And I've got a question for the whole panel, maybe initially targeted at Abyd, if that's okay, one of the largest investment banks in the world, if not the largest, I don't know, with trillions of investments. Yes, your climate finance business is significant and some very exciting projects, but I'm interested in the 99% of further assets under management that sits outside of your department. How are the wider pool of investors responding to your customers in terms of how you are evaluating every investment in terms of looking forwards? And secondly, is the climate finance that you as a bank representing your customers are going to be investing over the next 10, 20, 30 years sufficiently large enough? Is your ambition large enough, or are your customers' ambitions large enough to meet the targets of investment that we've heard earlier in this conference is required to move the energy sector and other sectors to where we need to be?
Okay. Thanks so much. And the last question here in the front.
Thank you. My name is Irene. Irene Hell. I'm a journalist. And as a journalist, sometimes you have to make really tough decisions, you know. Going to see Leonardo DiCaprio and Angela, or see you. So
Not
you
tough.
won.
That's an easy one.
That's a compliment. I don't know where. It's easy. In this case, it's so easy.
Yeah, and I have to say, it's because of your money. So
Wrong decision.
there are two people I'm especially interested why I said, Leonardo, I can't make it. It's basically Mr. Karmali. We met about 10 years ago, and I was very worried because he said he's going to invest about $50 billion in green stuff. And I said, I thought he's such a nice man, he might get fired. But it looks like you're still here, right?
Yeah.
And not just he's still here, you increased your budget. So I want to learn about how you survived and how you got promoted. And then we have the gentleman from the Rockefeller Foundation. And actually, I did a lot of research about your family, did many articles, because you are now saving the planet. John D. Rockefeller invented the oil age, and now you help to save the planet from what he did with his money, right? So what I would love to learn is basically this new blended finance you're doing. And the second reason I said to Angela Merkel, Angela, sorry, I can't make it, was because it's not Angela who has the key to save the planet and the climate, it's you guys. And your innovative forms of finances, and I would appreciate very much if you would help me to get as many sexy examples as possible so that I can spread the message, because it's really tough for us journalists to get through. But with big names like Rockefeller, it should work, right? Thank you.
Great. Thank you so much. A lot of pressure on the panel now, and not only you're like Leonardo 1 and 2 here, like which obviously we already knew. This is why we knew that. But at the same time, there, I think, sharing more of your experiences. But I think, yeah, as we have only a few more minutes till the end of the panel, I'd love you to actually make one more round from the other side and kind of addressing the questions here, while at the same time also giving your kind of the one thing that you think is needed to really help address the issue of getting us to scale with the speed that is needed, which is, I think, really the secret. Because I think what we've seen here is that there's many promising examples. We're going in the right direction. There's nice pilots out there. Innovation is needed still to make more, but at the same time, we need to scale. So we really need to come up with ways of replicating what works, but also kind of coming up with using maybe existing instruments in new markets, as Harald said. So what is the one thing that you think your organization or yourself would set as a priority to help achieve the challenge here? So Harald, let's start from your side.
Well, I have to contradict you, unfortunately, because I think, you should talk to Angela again, because she can do a lot. And I think she, what we found out, for example, first, many risks are created by public policy. If you have good public policy, you reduce these risks, and you set the investment process in motion in a way which then makes it much easier to deploy capital. The worst thing for deployment of capital is if you have policy uncertainty. So we need more policy uncertainty. For example, in the area of solar PV, we need harmonized PPAs. We need standard PPAs. It worked very well in many financial markets, having a global standardized contract approach. We also need harmonization of regulations. It cannot be that the investor goes to Kenya and has a completely regulatory environment than if he goes to Indonesia. We need to have harmonized regulatory approaches. That reduces also the risk of corruption, but perhaps that's why it doesn't work so often, that we have harmonization. I think, capital can only go so far. If we have too much risk, policy-made risk, we don't have enough capital to achieve the investments which we need, because capital can only be invested if the people are compensated for the risk they take.
Abyd, Leonardo.
Leonardo. So actually, I'm going to include Leonardo in my answer, because, and I'll try and address all three questions. Because the first gentleman, you raised the question of we need answers from outside the financial sector. I would agree with you. And that's why one of the solutions, I think, is partnerships. So Barbara, my one-word answer is partnerships. And what we've done is we've set up a partnership. It's called the Catalytic Finance Initiative. So Irene, this is what I'm doing now. The Catalytic Finance Initiative includes other commercial banks. It includes development finance institutions. It includes 4 big investors. And it actually includes Lorenzo. It includes the Rockefeller Foundation and Leonardo DiCaprio Foundation. And by the way, you should go to talk to him, because he really knows his stuff. No, he knows what's going on in his deal pipeline, within the foundation. So you'll get good answers if you give him an interview. And so what we've done under this initiative is basically say, look, we know we don't have all the answers. That's why we need to have partnerships. We need innovation. Innovation means, we don't claim to have all the solutions. We need to work together. There are different perspectives. There are philanthropic perspectives. There are social perspectives. There are, So now the gentleman over here asked the question about corporates, right? That was your main focus. So we don't have any companies. So we have corporate clients. We have institutional investor clients, and of course, individual, on the retail side clients. This Catalytic Finance Initiative is more about shifting big financial flows, trying to get create the new products, the new solutions, the step up in scale that Barbara's been talking about through, innovative partnerships and all that. On the corporate side, we have $125 billion. So Irene, this is the other part, right? $125 billion commitment over 10 years. So we finished the 50 early, which was good. And I think, again, look, it's good data to say it's becoming easier to deploy capital in the low carbon economy, because corporates want it. Corporates know they're on this transition. So we have a $125 billion commitment that cuts across every single part of our financial institution. that mobilizes interest from bankers and markets people and people on the wealth management side and everybody. Everybody, it's an arms race to the top in the sense that, it's a sustainability arms race, thank goodness. So everyone wants to come up with, new solutions. The companies are very engaged on this topic. They may not be so public about it for obvious reasons, but behind the scenes, there is a lot of work going on to say, look, how are we going to finance this transition? How are we going to recalibrate our business model? So I remain optimistic.
Great. Thanks so much, Abyd. Lorenzo.
Yeah, so what we'll be focused on, is over the next few years is continuing to really invest in best-in-class solutions that we think really can bring scale to this problem. And we're in this very privileged position where, we have incredibly flexible capital. The accountability we have is to our board and no one else really. And, we have a mandate to do this. So we're going to continue doing that. But I think that the bigger aim of all of this, and I think I'd like to underline one important point, is that the amount of such capital that is currently available is so limited, and we heard about that. And really, we're not going to get there as business as usual. And for all the name recognition that a foundation like Rockefeller may have, we just don't have the balance sheet to really move the markets in the time frame that we need. And what we would like to see, or what I'd like to see, is that through kinds of the partnerships that Abyd mentioned, the types of solutions that are being innovated, really that we bring government, and particularly the DFIs, the development finance community, to taking on more risk. And really that, I think, is going to be, in my opinion, one of the game changers.
Very good, like Upendra.
Yeah, not a Leonardo. You have heard from two. But I think we heard three Ps. We heard policy, partnerships, and potential, which is what a catalytic foundation like Rockefeller brings. But I think going back to the very first comment we heard, I think the biggest problem today in this entire space, and I touched upon it earlier, is that we are not thinking long-term enough. I think still the window of investments is 3 to 5 years in most cases, maybe 7. Whereas both at a project level and at aggregation levels, that's the conventional thinking for bulk of the capital. And I think we need to transform that to 10, 15 years plus. We, in our small way, we don't have billions, but in the millions are doing it at both levels, both into capital sourcing. We are avoiding partnerships which limit that model. And two, in our own deployments with the portfolios, that's what we are doing. And we are trying to do it with, create these beachheads for domestic debt markets to come in and see the deals so that then they can start taking it up either through refinancing, co-investments over a period of time once the cash flows are proven. So overall, I would again and reiterate, I think thinking long-term is really the key for taking impact investments forward. I remember some of the first discussions in Rockefeller Foundation in 2008. Anthony used to be the managing director. And at that time, a 5 to 7 year window was seen as catalytic enough, to be very candid. All of us were naive at that time, right? As these newer markets have opened up, you talked about policy and consistency and harmonization. I think that's very true, but that can only be seen over 10 year plus, and which goes to your point of the defense investments and others which are more strategic in nature and therefore long term.
Thanks so much, Upendra. Andrew.
Okay, I think the only point that I would like to leave everybody with is another consequence of blended finance. Multiple definitions, but the one that I like to attach blended finance to is the tactical and strategic use of public capital to mobilize private capital at scale. And the reason being that all the money sits in the private sector, and it's highly fractured. Save for the taxes we need to pay, it's absolutely at our own discretion as to what to do with our own money. And trying to marshal all of that around a single rallying cry is no small task. If you overlay that with the natural suspicion which occurs between private sector and public sector, and bring all these type of dynamics into around the rallying cry of blended finance, the one thing that is required to glue it all together is trust. And it's a common vision, it's a common aspiration, and it's a shared destiny. And I think the growing conversations around blended finance is creating the framework to actually create that level of trust, which is scalable that enables financiers to all start moving in a manner that they haven't moved in the past. And so I see blending as being not just about blending the money, but actually blending aspirations in pursuit of improved trust and a shared destiny.
Terrific. Thank you so much, Andrew. I'm going to use, unfortunately we're out, but there will all our panelists will stay with us over the reception, so I hope you will be able to ask your questions. Let me just use 1.5 minutes to sum up here and thank everyone. I think it's been a fascinating debate here. I thank everyone for joining me on this panel. I think for me, in a nutshell, again, as I said before, I can see that there's promising but mixed signals for Planet Finance and impact investment as tools to really scale up and address the climate challenge. I think the challenge really is how to get to scale, and I see that there is a number of ways of addressing that. I think it's about replication, it's about harmonization, it is about enabling a transformation of the investor basis, which includes impact investors, but also DFIs, so I completely agree there. And I think a way to do that is, again, the partnerships. I think we've heard about a number of partnerships on this panel, including the platform Harald talked about, catalytic facility that the Bank of America's anyway, the lab and others on. So I think again it's the partnerships, and I think this is really for bridging between the development and the different types of risk. It's for innovation and for making sure that we continue to come up with solutions that can bridge the gap, but it's also for enabling this dialogue between the public and private investors, really bringing them together. And I think that all is to create the framework to really build the trust that Andrew, that you were finishing on. And I think that how it goes hand in hand with having the right policy, enabling environment, and also fostering long-term thinking, as Upendra said. So with that, I would like to ask you to join me thanking this fantastic panel here. Thanks so much. And thank you to the organizers.